With SORA sitting near cycle lows at 1.03%, the interest expenses for Singapore property trusts are shifting dramatically. For everyday retail investors, this single macroeconomic change alters the entire calculus of your monthly dividend income. Today, we map out 3 S-REIT names seeing heavy market interest to find out where the real opportunities are hiding. 3 industrial names kept appearing on my radar this week, so I went back to the analyst coverage, pulled the consensus numbers, and laid out what I found. This is not a forensic verdict. It is a clean read of where the market stands on each of them right now. Looking at the opening note, it is vital to establish the scope of what we are covering today. This report was compiled by me, Angela, the market correspondent at the Investing Iguana, who focuses on tracking broader market developments and consensus analyst research. Because of that, this script operates as a faithful overview of prevailing market sentiments and data points rather than a deep dive carrying personal forensic ratings or structural verdicts. Think of it as a transparent look at what the financial community is saying right now, helping us establish a clean baseline of facts before any personal capital is committed. Moving forward, let's examine the current macroeconomic forces driving the wider Singapore market. The broader market context shows a significant shift in how income is being discussed across the financial community. With the Straits Times Index recently clearing an all-time high above 5,200 points, local dividend conversations are moving away from purely defensive posturing toward active interest. For regular retail investors trying to understand these shifts, seeing a major index reach these levels provides an interesting macro environment where quality income assets start getting a second look. We are focusing on 3 distinct businesses that continue to see significant trading volumes and retail discussion, laying out the baseline facts in plain language so we can learn together. Let's look at why this environment stands out. The strategic layout breaks down our core approach across 3 pillars: the environment, the focus, and the analytical method. Right now, the ground is shifting in a highly noticeable way for anyone seeking income in Singapore, making it the perfect time to review large industrial names. We are tracking 3 specific companies while highlighting the exact financial metrics that require deeper personal study. Looking at the big picture is an excellent starting point for education, but conducting rigorous analysis must always happen before any investment decisions are finalized. Next, let's break down the first major macroeconomic force impacting these property trusts. The most significant macroeconomic change is the clear easing of corporate borrowing costs across Singapore. SORA, which is the benchmark interest rate that local property trusts use to price their floating rate bank debt, has dropped significantly to hover near cycle lows at approximately 1.03% as of June 2026. To understand why this matters to our personal wealth, think of it exactly like a standard home loan. When your commercial bank reduces your mortgage rate, your cash outflows drop immediately, leaving more money in your bank account at the end of the month. Property trusts work the exact same way, meaning lower interest expenses naturally preserve cash flow for unit holder distributions. This chart highlights a critical metric for income investors, showcasing that Singapore property trusts are currently offering a highly attractive yield spread. Specifically, these trusts are paying roughly 3.8 to 4 percentage points more in dividend yields compared to completely safe Singapore government bonds. This gap is what institutional investors call the yield spread, and it represents the additional financial return you receive for taking on the physical property risks of real estate over a risk-free government asset. When this specific spread widens to this level, it historically acts as a powerful magnet that draws capital straight back into the property trust sector. Let's look at how overall market sentiment matches these numbers. The market sentiment overview reflects a deeper level of global and local institutional confidence flowing back into Singapore's economic ecosystem. The Straits Times Index climbing near its historic all-time high above 5,200 points shows that the general macroeconomic backdrop is significantly more stable today than it was just 12 months ago. This is absolutely not an invitation for any retail investor to chase high share prices blindly or abandon basic caution. However, it gives us vital context showing that quality income assets are operating with a much stronger economic tailwind behind them. Let's look at the critical underlying questions we must ask next. This observation block presents a vital perspective, reminding us to look beneath favorable macroeconomic headlines. While a low benchmark rate and a wide yield spread create an enticing environment, the real work lies in questioning how individual management teams handle this operational relief. Are trust managers actively using these lower borrowing costs to pay down the principal balance of their corporate debt, or are they simply using temporary interest savings to mask structural vacancies in older industrial buildings? Answering that question is exactly how you protect your capital. With that foundation set, let's turn directly to the three names we are watching. This section introduces the three specific businesses under observation: Mapletree Industrial Trust, Kaplan Ascenders REIT, and Frasers Logistics and Commercial Trust. Each name represents a major pillar within the industrial and logistics space, but they each carry distinct operational traits, asset allocations, and geographic footprints. By examining these names side by side, we can better understand how different management teams are positioned in the current low interest rate environment. Let's slide right into our first deep dive, looking at the data center narrative and valuation metrics driving Mapletree Industrial Trust. Mapletree Industrial Trust presents an interesting dual narrative for income seekers. The trust combines a large footprint of traditional industrial properties right here in Singapore, with a substantial expanding allocation to specialized data centers located in the United States. For anyone new to this asset class, data centers are the heavy-duty physical buildings that house the massive rows of computer servers powering modern digital infrastructure. This means the portfolio is tied directly to industrial manufacturing locally while simultaneously tapping into global technology demand. Let's look at what the latest financial models and market analyst consensus say about its current valuation. Mapletree Industrial Trust is trading at $1.94 as of 26 June 2026, sitting near the lower end of its 52-week range of $1.90 to $2.23. Investing Pro's aggregate fair value models place its intrinsic value at $2.84, suggesting potential model upside of around 46%. Meanwhile, 15 analysts covering the stock maintain a more conservative consensus target of $2.03. The platform notes that while net income is projected to grow this year, short-term obligations currently exceed liquid assets, a point to monitor closely ahead of the next earnings call on 23 July 2026. Every single time a person interacts with an artificial intelligence tool, streams a high-definition video, or makes a digital payment at a hawker stall, a server inside the data center somewhere globally is running hot. Mapletree Industrial Trust is positioned to capture that structural demand by leasing specialized space to tech corporations. However, as an investor, you must verify whether the hard numbers behind this portfolio can clear your strict income thresholds before allocating any retirement capital. Let's transition to our second name, Singapore's largest industrial trust. Kaplan Ascenders REIT is an excellent structural example of geographic and asset diversification on a massive scale. As Singapore's largest industrial property trust, its vast portfolio spans business parks, modern logistics hubs, data centers, and light industrial spaces across Singapore, Australia, the United States, and Europe. In plain language, having this level of asset spread means that the rental income funding your quarterly dividends is never overly dependent on a single building, a single tenant, or the economic performance of a single nation. Let's review the valuation snapshot to see how the market is pricing this immense corporate scale. Kaplan Ascenders REIT is trading at $2.54, which represents a 0.40% increase in today's trading session. This price sits noticeably above the Investing Pro model, fair value estimate of $2.09, indicating that a significant amount of market optimism may already be priced in. Conversely, 16 market analysts cover the trust with a consensus target of $3.09, showing a clear divergence between conservative financial models and analyst expectations. On the health front, the trust boasts a stellar track record of maintaining consistent dividend payments for 24 consecutive years, backed by a strong profitability health score of 4 out of 5. Kaplan S-REIT is a complete household name and stands as one of the most widely held property trusts among everyday retail investors in Singapore. While its immense corporate scale gives it massive negotiating power when acquiring new assets or refinancing its bank loans, we must remember that widespread discussion is very different from rigorous financial analysis. Understanding exactly what the balance sheet looks like under the surface is what matters. Next, let's look at a much quieter name operating within the logistics sector. Frasers Logistics and Commercial Trust receives far less mainstream retail attention, despite being tied to powerful economic trends. The trust manages a large portfolio of logistics hubs and commercial spaces spread across Australia, Europe, and Singapore. To understand the value of logistics assets simply, think of them as the massive warehouses and distribution hubs operating silently behind every online order you place. When you buy an item online and it lands on your doorstep the next day, it almost certainly rolled through a fulfillment building exactly like the ones this company owns. Let's examine its specific valuation metrics. Frasers Logistics and Commercial Trust is trading at 97.5 cents, experiencing a flat trading session on reasonable volume. The stock currently trades above the Investing Pro model fair value of 76 cents, which flags a potential downside of roughly 21% to that specific model estimate. However, the platform also highlights that the trust is trading at a low price-to-earnings ratio relative to its near-term earnings growth, suggesting the market might be underestimating its forward trajectory. 12 analysts cover the stock with a consensus target of $1.07, predicting the business will remain profitable this year, while carrying the same short-term liquidity characteristics as its industrial peers ahead of its next earnings on 5th August 2026. This comparison brings together the core contrast between a highly visible retail favorite and a quieter market participant. Both Kaplan S-REIT and Frasers Logistics and Commercial Trust offer significant exposure to the industrial and logistics sectors, yet their public profiles are completely different. The critical question we must ask before making any capital allocation is whether the household name genuinely commands a justified fundamental premium relative to its underlying assets, or if the lower public profile of the quieter name presents a different style of long-term value. Let's look at how we can analyze these setups together. In this fast-moving market, the critical line separating a secure financial sanctuary from a painful yield trap is frequently decided in a single trading session. While free subscribers are left reading yesterday's news, members of Iggy's elite investors are already actively cross-checking the next market setup together in real time. Elite investors get zero-day access on Substack and YouTube, the full Red Zone watchlist, and institutional-grade cheat sheets for just 9 Singapore dollars a month. That is less than a kopi and kaya toast set at Raffles Place. Link is in the description. We are entering a crucial phase of learning where we address the exact boundaries of market data. As we continue expanding our knowledge of dividend investing, it is absolutely essential to maintain complete honesty regarding what we do not know. Looking past glossy corporate brochures and polished investor relations presentations requires us to isolate specific financial blind spots. We have identified 3 major financial pillars that any disciplined investor must fully comprehend before drawing firm conclusions about any of these businesses. Let's break down the first major gap regarding debt structures. When analyzing a balance sheet, it is not enough to look at the total amount of liabilities. You must understand how much of that debt is locked into fixed interest rates versus how much remains exposed to floating rates. This specific breakdown is what determines whether a property trust possesses the balance sheet resilience required to absorb an unexpected macroeconomic shock if SORA decides to reverse its downward trajectory and climb higher in the future. Let's look at the second major area of study, which centers on dividend sustainability. A sustainable dividend must be funded entirely out of genuine recurring operating income generated by steady rental cash flows from real tenants. We must actively investigate whether a management team is relying on temporary accounting adjustments, one-off asset sales, or other non-operational capital sources to artificially prop up their distributions. If a payout is supported by non-sustainable items, it simply will not be durable over a 5 to 10-year retirement horizon. Let's examine our third gap, the interest coverage ratio. The interest coverage ratio serves as a vital financial safety buffer for income portfolios. In plain language, this multiple measures how easily a property trust can meet the regular interest expenses on its outstanding bank debt using the operational profits generated by its buildings. To spot structural warning signs before they negatively impact your monthly dividend income, you must learn what a healthy, safe coverage multiple looks like across different real estate sectors. Admitting these knowledge gaps keeps us grounded and reminds us why reading verified financial statements is mandatory. Let's move into our final closing reflections. The general easing of benchmark interest rates is undeniably interesting, and it provides a highly welcome operational lift across the entire sector. However, the objective here is absolutely not to direct anyone to buy shares in these three specific companies. We are sharing the exact baseline data points that caught our eye and explaining why this unique macroeconomic environment is worth close study. The immediate next step for any serious investor is to move past simple narratives and fully master the hard numbers behind the assets. The macroeconomic tailwind is real, but a tailwind alone can never tell you which individual boats are truly seaworthy. That is the exact question Iggy's deeper forensic analysis is built to address. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds. You said, I'd like to rewrite this script to be more like Angela and less formulaic.